Welcome to Money Mastery, where we discuss all things finance for everyday life. Welcome everyone to another episode of Money Mastery. On today's show, we will talk all about health savings accounts, otherwise known as HSAs, and why they are known as one of the best tax advantage accounts out there.
Yeah. We'll also talk about other health accounts out there, such as a flexible spending account or health reimbursement account, and talk about the comparisons between those and an HSA. So, Peter, can you start off and just tell us a little bit about what an HSA is?
Yeah, so an HSA, otherwise known as a health savings account, is known as one of the best tax advantaged accounts out there, like I mentioned earlier. But it's actually interesting, only 10 to 20% of Americans, it's estimated, actually fully utilize these HSAs and their maximum tax benefits.
Okay. So I don't believe everyone has the opportunity to contribute to these or use this account. So who actually can use an account, and how do you contribute every year?
Yeah, so in order to be eligible for an HSA and to directly contribute to one for the current calendar year, you have to be on what's called a high deductible health plan. And it also has to be HSA eligible. So just one thing to remember there, it's a high deductible health plan. You might see it called on paper HDHP, so high deductible health plan. And also make sure it's HSA eligible. So there is a rare occurrences where you could have a high deductible health plan, but it doesn't meet all the particular restrictions that you need to be HSA eligible, so it has to be HSA eligible as well when you have that high deductible health plan.
Yeah, it's very important to see that HSA eligible. Yeah, so we talked about high deductibles. What does that actually mean? For 2023, for example, is there a threshold that you have to meet to be in a high deductible plan?
Yeah, so for a high deductible plan in 2023, that deductible for an individual person is $1,500. For a family, that minimum deductible has to be at least $3,000. Okay. And then, so what this kind of means, to backtrack for some of you guys listening, is, so a deductible, once you hit that, so usually you'll have co-pays, et cetera, for a family plan or an individual plan for health insurance when you go see a doctor or some type of specialist. When you hit this deductible limit, then you'll hit what's called probably co-insurance, which you'll see maybe an 80-20 or 70-30, meaning if you have a health insurance cost, when you hit that deductible, 80-20 would be insurance covers 80%, and then the individual is on the hook for 20% of that. So that's your deductible. Now, to your point, there's also thresholds you have to meet for a max out-of-pocket to qualify for these high deductible healthcare HSA eligible plans. The max out-of-pocket for 2023 is $7,500 for an individual and $15,000 for a family plan. So in that case, once you hit that max out-of-pocket, you don't pay any more. You don't pay a single dollar for the rest of that calendar year. It would restart in January. But hitting that deductible and those max out-of-pocket numbers is important to be able to qualify as a high deductible healthcare plan to be able to then contribute to an HSA.
Yep. So just to be clear, there's a minimum threshold you have to hit for a deductible for it to be HSA eligible. And then there's also these maximum numbers that you won't go over as far as out-of-pocket costs.
Exactly.
Which is helpful to know.
Yep.
We talked a little bit about how great this is from a tax perspective, but because of that, the government typically likes to limit how much you can put into accounts, especially if they're very tax advantaged. So, are there contribution limits every year that you have, or can you put in as much as you want?
Yeah, so great question. So there are contribution limits for HSAs. For 2023, for a single person, that's $3,850, and for a family plan, which would be if it was me and a spouse or me and some children, on a family plan, that's $7,750.
So there's no delineation if there's just you and a spouse, or you, spouse, and kids. It's all the same.
Correct.
It's all considered a family. Okay.
Correct. So the one caveat I will say is I have seen where we have clients where they'll each be on their own individual health plans. For like a spouse, one could be on an individual. They could both be on two individual plans. Just keep in mind, you could both do an individual plan in that case, but you can't do a family plan because you're on individual health insurance. So one thing to know, if you're on an individual or family health insurance plan, you have different contribution limits. Sure. These are indexed for inflation, like most retirement accounts. So in 2024, that will go up, which is for a single person, $4,150, and for a family, $8,300.
Yeah, and I think once you hit a certain age, you can actually increase the amount you can put in there, right?
Yeah, so a big thing for all listeners is once you hit age 55 and you're age 55 or older, you can do an additional $1,000, whether that's a single or a family plan. You can do an additional $1,000 if you turn 55 or are older than 55 in that calendar year.
Peter, what happens if one of the spouses is 55 and the other is not? Can they still put in that additional 1,000?
Yeah, so whoever's the account owner, if they're 55. So say
Okay.
I was the account owner and I was 55, my wife was 53. Since the health insurance plan is through me, I can do an additional 1,000. If it was through my wife's health insurance, she's not 55.
Okay.
So then we couldn't. So great question that people ask about and something to know. And a big thing too, guys, to keep in mind is we've talked about in our IRA episode previously, and 401k episodes we'll get into further, is you have these contribution limits. For 401ks, you're familiar, there's probably employer matches and there's contribution limits for those. For a health savings account, it is more common now that employers are contributing to these for their employees as well. But these employer contributions count towards that contribution limit too. So say I have a job and I'm in a single HSA, which as we just stated was $3,850 this year. But if my employer puts in $1,000 for me, I can then only do $2,850 for the year, because you combine these contributions, and between the two of them, they cannot reach higher than that contribution limit for the year.
One other thing to note is that if you are on Medicare, you can't actually contribute to an HSA.
Correct.
So
Yep.
just please
It's a
note
good point.
that. So from what I understand, if you have an HSA and you want to utilize that for some medical expenses, there's qualifying medical expenses that you can use that towards. But if you end up pulling money out and using that money towards something that's not a qualified medical expense, is there a penalty for that?
Yeah, so there is a penalty for that. So kind of like any retirement accounts, if you take money out too early or don't use it for qualified distributions, then you could get a penalty for that. And regarding health savings accounts or HSAs, that's the same thing. So you pay income tax on this money if it's not used for qualified medical expenses. And if you aren't at least age 65, you also pay a 20% penalty.
Okay.
Once you're over age 65, the HSA, it's kind of like a traditional IRA in a sense where you could take this money out for anything, but it's taxable income, no penalty. But you really don't want to use it in that case either. You want to use a health savings account for medical expenses only, because then you don't even have to pay income tax either.
Yeah.
So big thing to keep in mind is making sure you use it for qualified medical expenses only, and that you want to take it out at post age 65 if you are going to use it for some type of emergency that's non-medical.
So we talked a little bit about the logistical sides of an HSA. Can you tell us exactly how they work?
Yeah, so these are the only account that has a triple tax benefit. So what I mean by that is this money goes in tax deductible. So a good example, like we've done for our IRA episode previously, is say someone made $100,000 and I put in $3,000 into a health savings account. When I filed my taxes for that year, my taxable income would only be $97,000. That's tax deductible. It lowers your taxable income for the year. It also grows tax deferred, meaning if I have $10,000 in that health savings account, I have that money in there, it's invested, it grows from $10,000 to $30,000. I don't have to recognize any taxable gains on that $20,000 of growth. The big thing then too is it comes out tax-free if you use it for qualified medical expenses. So you're really getting the benefits of a traditional IRA and a Roth IRA kind of all combined into one for a health savings account. And that's kind of why I mentioned health savings accounts are really known as one of the best, if not the best, tax advantaged account out there because of all these benefits you get from combining all these other accounts into one account.
Yep. So what's the purpose of having an account like this?
Yeah, so the purpose of these accounts is for people who are in high deductible health plans is you get to avoid paying taxes on this money before paying medical bills. So you get to pay these medical bills tax-free essentially and pre-tax. So this can help reduce the cost of your medical expenses for some people by up to by over 37% depending on what tax bracket you are in. And to kind of give you guys an idea of this, the good example is say someone has a medical bill of $1,000 and they pay 30% in taxes. So they need $1,000 for this medical bill really after tax. And how this HSA really helps you is, say someone wasn't on a high deductible plan and they had to pay this amount of money. They can't use an HSA. They're not eligible to. If they're paying 30% in taxes and their medical bill is $1,000, that would really cost them $1,380 because you'd have $380 in taxes in order to pay this $1,000 medical bill.
Okay.
Makes sense. So that's really where this really comes into play and is a huge benefit to these people. And the higher the tax bracket you were in, the bigger tax benefit you're receiving on this. To keep in mind, because you'd be paying more in a higher percent of taxes. But anyone benefits from this because you're avoiding taxes.
I know that you get a tax deduction for federal taxes. Do you also get a tax deduction for state taxes?
Yeah, so you can get that if you're in a state that has state income tax. You also get that benefit of it really forgives you from federal and state income tax, which is a huge benefit. And keep in mind, we're talking a lot about using this for qualified medical expenses. We will provide a link in the episodes below that'll redirect you to the IRS website to give you all the list of qualified medical expenses. There's a ton on there, so we're not going to spend 5 minutes reading them all out for you guys and bore you to death. We'll attach the link, but a big thing is there's many on there, and a big thing is Medicare premiums are count as a qualified medical expense.
Certain Medicare premiums, not all of them.
Yeah.
Right? Okay. Excellent.
With all that being said about that, Matt, can you just tell us a little bit more about how do we maximize these HSAs? Because I kind of preview that with the tax deferral you get from these growing from 10 to 30,000, but a lot of these people don't probably know, how do I get this from 10 to 30,000 if it's sitting in cash? Is that how that works? Can you do anything with this money in an HSA? Can you kind of explain a little bit that to me and to the listeners?
Yeah, so we talked a little bit earlier about the fact that there's only 10 to 20% of Americans that actually utilize an HSA. Of the Americans that actually have an HSA, about 4% of them are utilizing it in the most tax efficient way. 96% of people are actually not utilizing an HSA the best way possible. And what I mean by that is when you put money into an HSA, we talked about it before, it's triple tax advantage, but you have to let that money grow in there for it to really take advantage of that. So what we're suggesting is you get money in there, instead of paying for your medical expenses when you get them out of your HSA, you pay them out of pocket. So if you can cash flow your medical expenses out of pocket and let that HSA grow, that's where you see a lot of this advantage. So you let that HSA grow over time, and then as long as you hold on to your receipts. What I do is I simply just scan the receipts in and I put them on my computer in a file, and I have those for future reference. So if I need money 20, 30 years down the road, I can go back to these expenses that I had from 2023 or 2022, submit them and get cash from that. Now, if I've let it grow inside that account, I may not be using the principal that I put in there, meaning the money that I put in back in 2023 for that specific expense, I might just be using the growth. Now you ask, how do you get growth from this, right? The way you get growth in an HSA is that you can actually invest it when it's in there. So you don't have to leave it in cash. And I think that's where most people make their mistake. They put it in there, they either leave it in cash or they spend it right away on their medical expenses. So what you can do is actually get it invested inside your HSA and let that start to grow and work for you. The power of compounding interest, especially if you're young and you start building an HSA, you can have a 6-figure HSA when you go into retirement. And that's huge because we all know that as you age, you're going to have much more medical expenses.
Yeah,
right?
And I think that's really important. So a lot of people, when they open these HSAs, they get sent out a lot of times automatically these HSA debit cards to pull. Pay. You go to a chiropractor or doctor's office, and you just use that debit card right there to pay from your HSA. So a big thing, like Matt's saying, is if you have the cash flow to do so, then pay out of pocket from your bank account and don't use your HSA.
Yeah.
Because as Matt said, you can invest this money. We see a lot of clients that they throw the money in their HSA. They're getting that tax benefit to an extent where they're not recognizing any taxes to pay these medical bills, but they're not fully utilizing that third part, like you said, is, hey, we can invest this money and let it grow from 20 to 80,000 over these 10, 20 years. And as you said, is you're going to have medical expenses as you get older. So you're going to need this money. Plus, it just lowers what you need for your retirement income. If you have this money set aside, you're not taking as much out on your actual investment portfolio.
Yeah, one other component we didn't touch on yet that's really important is this is not a use it or lose it account. This account is yours. So wherever you go, if you go to a different employer, if you retire, it's your money, and it doesn't move, or you don't lose it. It's your account. I wanted to give an example too. So let's just say, for example, you go to the doctor and you have a $500 bill for some test that happened. Okay, what you do is you pay for that $500 bill out of pocket today. You save that receipt. So you save the receipt and you have that in your file somewhere. You let that money grow inside of your HSA because you didn't use it for it, right?
Right.
It's you paid it out of pocket. Now this is really only if you can cash flow it.
Yep.
But if you can cash flow it, this is the best way to go. 20 years from now, 30 years from now, you're retired and you need a little extra cash for something, you want to buy a car or whatever, you can compile all those bills that you've saved. So for this example, if you needed $500 in retirement, you take that receipt, you submit it into your HSA, and then you get that cash out, and that's completely tax-free.
Yeah.
And so over those 20 to 30 years, that $500 has grown, hopefully from $500 to, who knows, $1,500 or more.
Exactly.
And you're really only using the growth.
And I think that's the big thing too. Like a big important factor you hit on earlier too was save all your receipts. There's no timetable or deadline that you have to have these receipts spent by. You could have $6,000 of receipts saved up over the last 10 years, and then say there's an emergency from, say your hot water heater goes out or your furnace goes out and you need $5,000, and for whatever reason you don't have the cash flow at the time. We talked about you have to use these HSAs for qualified medical expenses, but you can theoretically pull the $5,000 there that you would need from your HSA as long as you have the proof of all these saved receipts that, hey, I have $5,000 of medical bill receipts that I can show proof of over these 5 years. These are all saved. I haven't reimbursed myself yet for it. So Correct. It does give you that flexibility. It's a good point Matt brought up, was save all your receipts, scan them in, or however best you organize it personally, and just always make sure you save them because you can reimburse yourself later. It doesn't have to be in 1 year. It doesn't have to be in 5 years. It could be 10 years down the road.
Correct. One other thing we talked about right at the beginning was we wanted to maybe compare an HSA to an FSA or an HRA. So we want to take a little bit of time and just kind of go over some of the differences there.
So yeah, Matt, so comparing to what you kind of said earlier, you mentioned to us and the listeners was there's also what's called a use it or lose it to that HSA where you can carry over year to year. There is what's called a flexible spending account that's kind of being phased out now a lot for the HSA and its popularity it has. The flexible spending account, otherwise known as an FSA, that has that use it or lose it feature. So a healthcare FSA similarly empowers members to set aside pre-tax money to pay for eligible medical expenses. The difference is people that have FSAs do not keep their unused money within that account. All the funds have to be forfeited back to their employer. So if you have $3,000 in there that you contributed throughout 2023, but you only had $2,000 in medical expenses, you lose that $1,000. You can't carry that over like a health savings account and invest that money. So if you don't have a high deductible HSA eligible plan at your employer, this is a good alternative because you at least still get to use the pre-tax money instead of paying health insurance or instead of paying healthcare costs after tax.
Yeah. The other account is an HRA, which is technically called a health reimbursement arrangement. Most people call it a health reimbursement account. Basically, that's an employer-owned or an employer-funded account, and it's designed to help members bridge the gap on eligible healthcare expenses. So HRAs are highly customizable and a great way for organizations, per se, to help offset rising costs. The common eligible expenses include deductibles, co-insurance, and copays. So people that have an HRA can use that account to pay for those things. And they're not the ones funding it. The company is. Yeah.
So it's a great idea just to know. I mean, we focused a lot on HSA for you guys because that's really becoming the popular health account for people to try to save and avoid paying taxes on these healthcare costs. And just to kind of paint you guys, we have this table on the screen if you're watching on YouTube, so you can kind of see this visually. But for our Spotify and Apple Podcast listeners, just kind of have the general idea that an HSA, tax-free distributions, FSAs, you have tax-free distributions, and health reimbursement arrangements or accounts also have tax-free distributions. All three of them have that, all provide you with a debit card, but just know the key differences here is that health savings account, you can invest that money, you have tax-free earnings, and it can be used as a long-term savings account, where that FSA and HRA do not. The funds expire in that FSA and HRA, like we kind of hinted at earlier, but they don't in the HSA. That's the key differences between these three accounts. And just know, we talked a lot, like I said, about that HSA. But if you don't have an HSA eligible plan, or for whatever circumstance you can't do an HSA, you can't afford it, FSAs and HRAs are still at least good backups if you can't do an HSA. So that wraps up our episode today on health savings accounts. Don't forget to like and subscribe and share with any friends and family that you think would benefit from our content.
Stay tuned for more content from Money Mastery. And if you have any questions, feel free to email us at moneymastery@McGloneSuttner.com. Thanks, guys.